I'm Marilla Fernandez. Thanks for joining us on Market Call. Lyle Stein on the show with us today, president of Forvest Global Wealth Management. He'll take your questions today on North American and global stocks. Here's how to reach us. 1-855-326-6266 if you'd like to dial in. You can email as well, marketcall@bnnbloomberg.ca. Good to see you. Thanks for coming in.
You're very welcome. Nice to be here.
Let's talk about next year, because you've mentioned you're cautious looking ahead. Why is that?
Oh, there's a whole bunch of reasons, Marilla. But let's just start with where we've been and then look at it in the context of what we always look at, which is the outlook for earnings and the outlook for interest rates. It's been a great year, like in Canada in particular, but it's been a very good year for capital markets. Yet interest rates in the U.S., the U.S. 10-year benchmark Treasury bond, has not done much lately. It can't break that 4% level. Mm-hmm. That's a great impetus to get investment going, but it's a barrier now. Earnings growth looks very good for next year, but it has always looked good for next year. And it's just a quibbling, is it going to grow at 10%, 11%, or 12%? A lot of the expected growth coming next year is because we're going to see a little bit of a softer fourth quarter than people had expected. You put that into the hopper, so the fundamental background of rates and earnings, okay, but there's so much uncertainty. Start with tariffs. Are we going to get a tariff decision out of the Supreme Court this month, maybe early next month? What's going to happen with inflation? We've been hearing a lot about companies holding off price increases until they get clarity. Are they going to raise prices? The Fed, I think, is expecting a little bit of confusion in that, and so they're going to wait. Powell told us that. We'll wait and see the numbers before we go. So you've got that element. Then you still have the ongoing conflicts around the world. Mm-hmm. Oil prices are $58. What's going to happen if there is some sort of peace agreement? All these things, I think, are causing great uncertainty. And the U.S. dollar, we can throw that into the hopper as well. You
were saying follow AI investment to follow or to anticipate where the economy is going to go. Explain a little bit.
Yeah, I think I grew up with the notion we're going to look at what GDP is going to do and that be a great indicator for where markets are going. The notion is markets move 6 months ahead of GDP, 7, 8, 9 months. But we spent a lot of time looking at industrial production and this little piece of economic trivia and that piece of economic trivia, when the reality is the market now has become over-financialized the world. Interest rates are probably more important than they've ever been, given the level of debt that we've had. Oh, yeah, I should put that into the hopper as well. Debt is a big element today, and if the cost of money goes up, that's a huge burden on not just the economy, but the people who are participating in the economy.
And so AI investment is going to be a sort of top-line concern?
I think so. We speak of a K-shaped economy. There are those, and if you got a K, right, there's the line, and then there's the up leg and the down leg. The people with assets, the people with houses, they're all on the up leg of this K. They've done phenomenally well. However, you look at that downside of the K, there are a lot of people who are concerned about their jobs. There are people who don't own houses. There are people who don't own stocks. They're not participating in this economy. On average, you got up and down, you kind of do this, and it's kind of muddled through on the big number. But there's, I think, a growing discontent among that lower K keg. And that's what we need to get economic growth going. Tax increases. They don't necessarily help these people, but they don't help these people either. It's those uncertainties. And so we're just going to sit here for a while and get a sense of where things are going.
Okay. We're going to take a quick break. We'll line up the first phone calls and emails for Lyle Stein, Forvest Global Wealth Management. Again, he's taking your questions on North American and global stocks. Back in a moment. Welcome back. Let's start with an email. She's got a question. It's Anne, and she has a question for Lyle. She says, hi, I'd appreciate your feedback on PPL versus CNQ. Can we pull up CNQ first and just take a look where it's at? With the price of oil, and you touched on this at the top, sort of being crushed a little bit this year, what is your forward take on some of the energy stocks?
Well, the energy stocks, I think, are an interesting play from a longer-term perspective. Canadian energy stocks have not been the favorites in the world, rightly so, given our political preferences for things green. I think there's a renaissance taking place. That said, C&Q is the big guy on the block. When we look at C&Q, you can see it hasn't really done anything other than pay its very nice yield. It yields 5%. Nothing wrong with that cash flow. It's got heavy oil. It's got not as much gas as we'd like, and that's why we don't own C&Q today. We've owned it in the past. It's got refining assets. It's a nice integrated producer in Canada. It's kind of the big cap name that you go to. It's more dependent on sentiment towards energy, which goes back into what we talked about as the oil price. So, like I said, we don't own it. Our preferred positioning is in gas stocks. Our energy portfolio, leave pipelines out, is totally biased towards natural gas plays. Then you look at Pembina, and Pembina's kind of done the same thing. It pays a nice yield. We don't see a lot of catalysts in the stock. So, our preference for this midstream area is something like AltaGas as opposed to Pembina. A lesser yield, but they've got some unique plays that give us better growth out of that area. And if we're looking for income, we can get that out of the pipeline companies. So we don't own either of them. Like I said, C&Q might be a go-to when oil prices look to be strong, but we don't know what's going on in Venezuela, let alone Iraq.
Day to day, that is true. Okay, let's move on from Anne's email to Rob on the line in Calgary. Hi, Rob.
Hi, thanks for taking my call. I'd like to hear Lyle's opinion on HSBC. I'm wondering if he feels that if this bank is performing to expectations relative to its peers, or if he has a preference with other European, Canadian, or American banks. Thanks again, and have a good afternoon.
Thank you very much. HSBC, we haven't looked at in a while, so let's do that right now. It's at 78, 77 today, so up 63% on the year, a little bit up on the day. Tell me about HSBC and how it does perform in that space.
In this, it's an interesting name. We did not get the bank stocks right this year. I'll be the first one to admit it. HSBC has been a leader in Europe. The best performing bank stock in Europe has been Deutsche Bank. The big European banks have really benefited as rates fell and as the prospects of kind of doom and gloom in the European economy have improved. So HSBC gives us that exposure. It's one we'd like to look at because relative valuations in Europe are just so much more compelling than they are in North America. But it's not a name that we own. I think, the question comes, how would it stack up? It's hard to get excited in a flat interest rate environment about bank stocks in general. But I could have said that a year ago. And like I said, we didn't quite get the banks right.
Okay, let's move on then to Tony on the line in Toronto. Hi, Tony.
Hi there. My question is on BCE. What do you think of this as something for your TFSA as an income stock? Do you think there's any chance for a recovery? It's quite beaten down here. Thanks.
All right, thank you for the question. BCE, will remind people, parent company of this channel under the Bell Media brand, cut the dividend, which investors did not, of course, like. But there were rumors of that for some time. It's at $31.15. Do you see a recovery for BCE ahead?
We don't own it, not frankly interested in looking at it. And the big reason is BCE is tied to the Canadian economy. And we are not that optimistic on the Canadian economy. We don't think that what's been driving Canada, the real estate sector in particular, is going to be the impetus to the future that it's been in the past. BCE is in a highly competitive cell phone market. It's in all its businesses are now competitive, where it used to be a regulated utility. Those days are gone. The dividend cut, finally, everybody can go, whew, it's behind us. But what's that growth? And you can see it in their acquisition of the U.S. assets that happened in the fall. Yep, they went out to get growth there. Maybe the best question for BCE is just slowly let the cash go, as opposed to feeling that we have to grow the stock. So to us, it's not an attractive industry. We don't own
anything in the space.
Exactly. We're avoiding the space. We're avoiding domestic Canada to the biggest degree possible.
Interesting. Okay. All right. Let's get to Ray then. Ray's on the line in Hamilton with the question. Hi, Ray.
Oh, hi. Thanks for taking my call. I was just wondering what your thoughts are, seeing as it looks like we're going to have central banker as our prime minister for the next 4 years, if this is going to be advantageous for the 6 big banks here in Canada.
Okay. Thank you for the question. You talked about not getting banks right for this year. What do you think about Mark Carney being the man sort of leading the country, and whether that would be good for the banks?
Well, I think Mark Carney's a lot better from the banks than the previous person in the office. So that's a positive. The difficulty is looking at Canadian bank stocks today, they're not yielding the 4.5%, 5% that they were 12 months ago. They're yielding 2.5%, 3% plus, maybe. You just don't have that dividend impetus to grow. Again, domestic issues arising out of real estate. Our economy is bleeding jobs. Let's be.
We've been creating jobs as far as we've seen in the report, but you mean looking forward, you expect it to change?
Yeah, the jobs we've created are not the jobs that are being destroyed. The high-value manufacturing jobs that we've lost aren't really doing it. And that's a problem, I think, from Canada as a long-term growth country. So anyway, the bottom line is the yields just are not attractive. I'd rather get a 4 or 5% yield from a utility or a pipeline company than I would from a bank stock. In fact, even C&Q relative to a bank stock with a 5% yield gives me commodity oomph. I'm not going to get that commodity oomph by owning a Canadian bank.
That being said, I'm wondering whether Mark Carney will introduce more competition into the space. There was a lot more competition in the UK, which seems to work better for investors and for the public.
Yeah, I think that's a really good point. The whole Fintech revolution, jobs are being created in the Fintech industry. That's taking away the traditional business that banks have been in. They're, if you look at the U.S., the big money center banks, and even now some of the regionals are getting out of some of the loans that they previously would have issued, and they're lending that to private credit. Let private credit step in. We'll fund the private credit companies, but we're not going to go in and do the work, do the legwork, do the collecting of all these little, I'll call them mom and pop, but they're not loans that they've accumulated. So we just don't see the strength in the Canadian economy to be the big impetus to growth. And so you got to get growth behind that 3% yield. Otherwise, you're not going to get your 6, 7, 8% total return.
Okay. Let's take a quick break. We will line up more phone calls for Lyle Stein, Forvest Global Wealth Management. Your questions today on North American and global stocks. Here's the number and the email address. We're back in a moment. Welcome back to Market Call. We're going to start with an email right now from Sharon, who says your thoughts on Baylin at this price. Baylin does wireless services. I have them as sort of antenna technology, that kind of thing. And I'm not sure how much you know about it, but they're 26 cents, but down 35% over the year. What would you do with stock here?
Well, we avoid these kinds of stocks for a particular reason. In managing other people's money, we tend to concentrate on larger, more liquid names where the impact of a specific event can be diversified through just the customer base and the number of lines of businesses. Baylin is concentrated in this antenna, but I think it's a very interesting growth area to be in, but it's a $55 million a year revenue company. It's awfully small. I mean, as a individual investor looking at something like this, put 2% in and hopefully it works. But in the context of a larger high net worth client, it really just doesn't fit. If we're going to go into, take a go at small cap names, we'd rather own a fund of small caps than try to figure out if Baylin's better than XYZ.
One stock. Okay. Let's go to Michael then. Michael's on the line in Vancouver. Hi, Michael.
Hi there. Thanks for taking my call. I think Jeff Bezos and Amazon are laying off tens of thousands of employees, if not more. So is it a good investment? In other words, because I think we're over the 1%er bubble. Thank you.
Thank you. So Amazon, can I get your thoughts on big tech first?
Yeah, big tech is interesting. Again, the Mag 7 seem to be losing momentum. That whole AI trade is now starting to be shaken out. When I say hyperscale, you've got Amazon, you've got Meta, you've got Microsoft, you have Google, NVIDIA makes the chips. This space is being, I think, coming under a little bit of question. The growth potential in this space doesn't look to be maybe as good as it has been. It's been great. I mean, NVIDIA, what they've done is amazing. You know what? 3 years ago, they had a $500 million market cap, and now it's $5 billion.
Yeah. Trillion.
I got to go from billions to trillions.
Exactly,
Yeah.
yes.
Throw some zeros out there. It's been amazing, but can that continue? Increasingly, the AI space is being questioned because of the energy that it requires. Our theme over the years has been, own natural gas as the transition because it's natural gas that's going to fire all the power that's being used by these AI places. So now let's get to Amazon. Amazon is a hyperscaler. It's got a really good, I'll call it a retail business. It's got Amazon Web Services, which has been, a leader in data center and data center sales. They've got a great database. It's been a laggard here. It really hasn't done anything. We own it. We own it because when we look at the names that I mentioned, they're all 25 to 30 multiple stocks. But in a world where there's great uncertainty, I feel much more comfortable that Amazon will meet its growth expectations because of the diversity of its businesses than I would in something like an AMD, where something comes out of left field, maybe energy, maybe something else, maybe it's quantum computing, changes the whole scenario. You've got a stock like Amazon that's still got its cash flow from retail. And the big thing I think that's starting to come into the AI trade is now we're starting to question, well, where is the cash coming from? And you're seeing that in Oracle, you're seeing that in OpenAI, Blue Owl, all these names that have been the stars are certainly starting to see a lot of pain because of the financial requirements to make the game go on.
Yeah, some are going into debt, but as you mentioned, if some have other ways of bringing in the revenue, there's some offset there for Amazon with the retail business.
It's that stability that makes a difference. So we'll talk about that later.
Okay, let's go to Kareem. He's on the line in Ajax, Ontario. Hi, Kareem.
Hi, good afternoon. Thank you for taking my call. My question is on Propel Holdings. Just wanted to get your guest opinion if it would be a buy, hold, or a sell at this point.
Okay.
Thank you very much.
Thank you for the question. So Propel credit, 25.70 is where they are. They're down almost 30% on the year, currently at 25.70. There was a lot of interest in the stock at the start of the year. I'm sure a lot of people put some money in early on. It hasn't done very well. It's been hit by credit concerns overall.
Yeah, and we don't own it. It's one that I'm intrigued by, though. This whole fintech space is really interesting. I've spent some time with the management. Actually, I've spent, I think, 3 times in the last 2 years. I was on the show with the same time as the CEO.
Okay.
So it was kind of fun talking, and I spent some time with him and the CFO to understand their business model. Intriguing in the sense, and what's got the street a little bit concerned about it is the fact that their loan loss provisions are very high, but they keep turning over their loans so often, they can actually make money, even though their loan provisions would make bankers, squirm. It's just, they're high. Momentum has come out of the stock. It's an interesting growth name. It's an interesting space. There's others in there that we've looked at as well. We just haven't pulled the trigger on it. We want to see a little bit more clarity. They had, I think, soft quarter last quarter that really kind of got the stock knocked down. Want to see how they're recovering from that. But it's a growth name in a growth space, and I like what they're doing with respect to using modern financial as opposed to bricks and mortars.
Okay. Let's move on to William. He is in London, Ontario. Hi, William.
Good afternoon. By the way, my sister likes working with Lori Reeves in your office. My question is on VET, if I should buy more of it or just hold.
Okay, thank you for the question. We'll pull up Vermilion and have a look at the line chart in a second. Vermilion, what do you think about VET on the TSX?
We own it. We own it as a gas play. Vermilion has struggled in the last 2 years. With 2020 hindsight, maybe wish I didn't own it.
How long? When did you buy it?
Oh,
roughly?
gosh, we've had it 3-4 years.
Okay.
Yeah. We bought it when Russia invaded Ukraine and European gas prices shot up.
Got it.
And that has been the real impetus to Vermilion's, I would say, last 5 years' success. It is, for example, the largest independent oil producer in France. It is a large producer of natural gas in Europe. Europe needs natural gas. The natural gas that's coming from Russia may not be coming anymore. That we think is a leg. But they also made an acquisition to bring more gas into their North American portfolio. And the market didn't really like that. They were like, oh my gosh, you're making the wrong acquisition. I followed these guys for much more than the years we've owned it. They've done an amazing job of returning money to shareholders. They've done a very good job of being capital disciplined. And so when you put that in, that's a good management team with a good management story that's continued between and amongst all the various CEOs they've had over the years. So we like that. Like when you look at a company that's able to recycle well in the gas space, this one is particularly cheap. So it's a name that we own, we continue to own, pays a 4% dividend. So we get paid while we wait. And I think the street just doesn't like it. You could get a multiple expansion as they continue to do what they're doing, execute well.
Would you buy in then at this point?
Yes, I would.
Okay. Let's take a quick break then. We will come back with Lyle's past picks. That's coming up next. All right, time now for a look at Lyle's past picks from February 7th of this year. Cameco was the choice at the time, CCO on the TSX, 71.30 at the time, now to 124.22. So 74% upside, 75% when you include dividends, so total return. Did you choose this at the start of the year for build out of nuclear? What sort of was your idea of Cameco investment?
We talked about thematic investing before. We talked about the green transition that wasn't going to be as green as the Greens originally wanted. Natural gas is the transition ultimately to nuclear. And what kind of turned us, I mean, Cameco's got the uranium mines. We all know that. But the Westinghouse acquisition they made was quite interesting. Now they have 50% interest in what I would call sort of the arms supplier to the nuclear business. It's a great asset. Anything that's growing that uses nuclear is going to touch Westinghouse some way. So we saw that as a really interesting growth avenue beyond just having production of yellow cake and the stuff that goes into reactors. We make the reactors. That's a long-term business, stable cash flow, and that was the most attractive thing that kind of, I guess, flipped the switch to buy it.
And is any of that paying off yet?
Yeah, it is. As uranium prices rise, that's good. You saw the Trump administration talk about where we're going to build 10 new reactors.
Yes.
That plays into Westinghouse.
And now New York State is partnering with Ontario to build some nuclear out as well.
Yeah, and that is a growth industry to us. Is it as attractive today as it was? Well, no, because the stocks moved. But as a long-term investment in this theme of where are we going to go to fund these AI or to power these AI centers, to us, it's still a great hold.
Okay, let's go to your next pick from February, AltaGas, ALA on the TSX. We touched a little bit on this in the beginning of the show, 34.85. When you recommended it to 41.08 today, 18% upside and 22% total return. And I imagine you're holding on to AltaGas.
Absolutely. It fits that same theme as well, except AltaGas is at the end of the pipe. So when you think of, again, our thesis is very simple. We produce gas up in Alberta and BC and Saskatchewan, and then we move it through TransCanada and Enbridge to the East Coast where they power all the data centers. Well, guess what? AltaGas has the gas distribution license to Loudoun County, Virginia, which is the home of the 50% of the U.S. data centers. So I've got a growth vehicle there. But they also have growth on the other side, which is their export of propane and liquids to Asia. So you've got two unique aspects of growth that make the stock quite attractive. So anyway, still like it. The yield hasn't been what it was. It's nice when a stock goes up like that, and it's gone up more than just 20%. So it's a great name with growth and dividend as well.
Out of curiosity, are you going overweight in those themes? You talked about theme investing. You've gone Cameco, you've gone AltaGas, build out for AI. Are you going overweight in those sectors?
Well, overweight is such a funny term. We have positions in these names. To us, a position is a 4% holding in a client portfolio. So we'd have 4% in Cameco, we'd have 4% AltaGas, we'd have 4% in pipeline companies. I mean, that's a normal position. It's overweight if you look at its relative weight to the index, but this whole index thing drives me bonkers. And we can talk about that.
Okay. Let's take a look at your third pick from February, Generac, GNRC on the New York Stock Exchange, 142.11 US at the time, down to 138.94 right now. So 2% downside return and total return. They make the generators, I guess. Is it sort of fewer storms that perhaps we've seen?
You nailed it.
Okay.
That has been the problem with Generac. There were no hurricanes, there were no tornadoes, there were no mass outages over the course of 2025 that usually drive the stock. We like it for a couple of reasons, and we had sold it. Like we sold it at $160. Okay. Basically, without the news of hurricanes, and no bad news is unfortunately no good news for Generac. I mean, you hate to say it, but that's just the reality. But the stock price has come down dramatically. It also is a bit of an AI play. They make not just the home generators for our backyards, but they make generators for data centers. And they are gas-fired, diesel-fired, the kinds of things you can put on quickly as opposed to getting a combined cycle generator from GE Vernova.
Are they the backup systems for the data
They're the
centers?
backups.
They are.
And so, we speak about backup power. Diesel, nobody wants diesel nobody wants data centers in their backyard. Heaven forbid that you'd have a diesel polluting backup generator in your backyard associated with the data center that's sucking all your electricity anyway. So there's some political upheaval against backup power. That court is still in session.
Okay. Let's take a quick break. We'll get back to the phone calls and the emails in just a moment. Stay tuned. All right, let's go back to an email from Jack. He says, I'm invested with 80% equity, 20% bonds. Considering market's current volatility, if I want to be on the safe side, does it make sense to replace my bonds investment with gold or in a split percentage? Lyle, we were talking a little bit about this at the break, but what do you suggest?
Wow.
Yeah.
How much time do we have on this one? No, it's a fascinating question. And we come at it from a different perspective. So we always ask our clients, how much money do you need today for income? How do you protect that income stream? And then the balance is what you're going to have in your portfolio to grow. We call it comfort income. We call it calamity. You got to protect your income stream against calamity, and then charity or children. That's really where a portfolio is, and each person is different. So it's hard to answer this question specifically. So let me tell you where we are. From a comfort perspective, bonds have been always the way to get some income, but the yields just aren't there at 4%. And they're coming with what we perceive as more risk today than less risk. The inflation that we talked about earlier is uncertain. Calamity protection is where gold comes in. And so if you want to buy gold as an asset to make money, we don't think that's the way to look at it. We look at gold as a way not to lose money or to protect yourself from the two major things that can whack a portfolio over time. Inflation again, or geopolitical uncertainties.
It's been hard not to look at gold as a way to make money this year.
Which is kind of weird because gold's gone up, bonds have done well. I mean, a lot of funny things are correlating that normally aren't. But when you look at gold as an alternative asset class, it has been for centuries, millennia, the protector of client assets. And so we like that. Now, a lot of our position in gold, and frankly, we're well through 20% in our client portfolios when it comes to gold. And going back to it, we're at our minimum, which is about 20% in bonds. So we own gold relative to bonds because of that calamity protection. But a lot of the position that we're in happens to be from the fact that as a Swiss-owned company, we would always have a bias towards gold. Gold's done really well, so what had been an 8% position is now close to a 20% position. And we've had to peel some of the holdings down over the year to kind of keep it within a well-diversified range. But within that range, it looks like the place to be. So I would, not tell the client to sell his bonds because of anything other than a fear of not having the income that he needs. If you got to have your 20% bonds for income, have it. If you want to protect that, have some gold. I wouldn't move all my bonds into gold, but I would keep an above average gold exposure just for that protection component.
Okay. Let's go to Jim then. Jim's on the line in Peace River, Alberta. Hi, Jim.
Hi. Good morning, and thank you for taking my call. It's on Peyto. In January, I'm going to slide $7,000 into my TFSA. Is this a good time to take a position in Peyto in my TFSA? Thank you very much.
Thank you for the question. Peyto is up 43% on the year, up today at 22.42. Would you take a bigger position in the TFSA at this point, seeing as how it's up on the year?
Without knowing Jim's position in natural gas stocks, it's hard to say, would I take a position or not? We have about 10 to 12% of our total portfolios in natural gas stocks, Peyto being one of those names. Now, we had the great fortune of buying Peyto about 2 years ago, maybe a little bit more than 2 years ago, when it had a 14% yield.
Wow.
Yeah. The market didn't like it because they've taken on debt. Well, we had this view of natural gas, and it was a really interesting way to get a total return coming from the bird in the hand or the dividend. So we had a big position in Peyto, which has done extremely well. It's at a full position in our client accounts. We haven't added to it lately because we have a full position. I wouldn't sell it because it's a gas stock. It's a great gas play. And it's actually better today than it was because there were financial capital structure concerns 2.5 years ago. Those have been alleviated with the earnings that they've made over the last 2 years. So it's a name, again, look at it in the context of your total exposure to gas. But if I had to pick a name in the gas sector, this would be a go-to one.
All right. I hope that works for Jim. Let's go to Michael. He's in Montreal with a question. Hi, Michael.
Hi, Marilla. Is it possible to have Lyle's opinion on Alimentation Couche-Tard? And since they failed in acquiring 7-Eleven, do you see them as potentially acquiring Casey's General Stores in the United States? Thank you very much.
Okay, thank you for the question. So I have a broader question related. Because this is a company that's known to acquire and grow, and as he mentioned it didn't grow from getting 7-Eleven, that deal didn't work. What else is left for them to acquire to keep this model moving? He had a good sort of suggestion here. Do you see that happening?
It's possible. This has been a kind of a heating up M&A type market. You never want to make acquisitions when everybody else is out there looking to do deals. They are the go-to deal maker in this space. So if you're a seller, you're going to immediately turn to ATD. I'm not a big believer in buying companies that grow by acquisition. I love internal growth. It's a much better, safer place to be. What tweaks it now? We have it on our global list. We don't have but a small position in it. But I'm intrigued with the whole movement towards the petrochemical solution to transportation, which is part of their story. They sell gasoline at the end of the day. And the green thing was going to wipe out Couche-Tard. It was going to be a no-growth stock. Well, the world is changing. We keep hearing in the U.S. the term affordability. Affordability isn't working with the green agenda. They're seeing that problem in Europe. Guess where else that we're seeing that problem? It's in Canada. They actually play into that. As consumers buy more and more gasoline-fired cars, this is ultimately good for Couche-Tard and its model, and the stock is soft. So it's one, like I said, we have a tiny position. We're just looking at when do we pull the trigger and buy more.
Okay. Let's take a quick break then. We will be back with Lyle Stein of Forvest Global Wealth Management. He's taking your questions today on North American and global stocks. Thanks for joining us. Welcome back to Market Call. Let's go to an email from Guy. He says, may I have your guest's opinion on Honeywell? We'll pull up the chart for Honeywell, which is in the process of splitting off. It's both aerospace and something called Solstice, which happened in October. But here's Honeywell International at 196.30. So down 14% on the year. Is this a stock you've invested in at all before?
No.
Right.
But we're looking at this one. We're looking at this because of the spin out, but also it is a supplier of industrial automation and things like that. Maybe, you think of Honeywell, you think of measuring things. That's their business. As the U.S. is onshoring more and more manufacturing, that's a real plus for Honeywell. The financial restructuring, think about the last big U.S. industrial company that restructured. It was called GE. And you've had Vernova. They have another spin out that eludes me right now. It's done very, very well. The fact is that the company is now trying to create more value as being separate companies than it was on this conglomerate notion. And I think that makes a lot of sense. Get the right pieces, and away you go. So Honeywell, again, looking at industrial products in the U.S. because of the nature of reshoring, and then with the added catalyst of providing some additional upside through diversification out of the companies that they hold.
So it's on your watch list.
It's on the watch list. Yeah. we can't own everything. When you have 4% positions, you got to be very, very selective in a portfolio.
Absolutely. Okay, let's go to another email from Alan. He says, I'm a retired dividend-focused investor. What are your thoughts on buying CPX at the current price for a long-term hold, or do you prefer another Canadian power generation stock? Let's pull up CPX if we can and take a look at where we are. But what is your take on Capital Power?
Well, it goes back to that question we had at the beginning when we were talking about Canadian telecos. We were talking about Canadian banks. Why do you have to have a Canadian power generation stock? The emailer is a dividend investor. I think you can do a lot better in the pipeline stocks in Canada than you could in a Canadian power producer. Now, I haven't followed Capital Power that closely because of, again, I'm looking for more of a global exposure than domestic, and we've got great dividend payers and other names. Don't have to own this name. It has been a play on AI center growth in Alberta. That's great. I think that's fantastic. We own AltaGas.
Okay.
We don't have to own.
Would you know what the dividend is for AltaGas? 4.67 is where I have for Capital Power.
I think AltaGas, last time I looked, is probably 2.5. I mean, it's come down quite a bit.
Okay. All right, let's get to an email from George. He says, I'd like to hear Lyle's thoughts on the healthcare sector. Would he be interested in buying into any names at this time, or is he steering clear? Healthcare, and I'm going to ask more sort of North America rather than just Canada versus
we really don't have any healthcare stocks.
Beaten down at the start of the year. Some of the names are starting to come back. Not sort of overly. There's not a huge action, but they're moving. What are your thoughts on healthcare? If you're going to be invested in healthcare, which part would you invest in?
And that's the really difficult question, because healthcare isn't just healthcare, right? You've got drugs, you've got appliance makers, you've got nursing homes. I mean, there's all kinds of ways to participate in this industry. We'll talk about that a little bit later. But the interesting thing is the drug business, and the drug business was hurting. It seems to have a bit of a renaissance here. The appliance manufacturers, look, I'm the kind of guy that gets knees replaced. I play soccer.
Devices right now, yes.
Yeah, devices make sense. But even amongst the device makers, you can have a Boston Scientific, you can have a Stryker, Edwards Life Sciences. I mean, they're all over the map. So you have to be very selective on the stocks you want to own. Our preference is for the device makers. The drug companies are interesting. We had Novo Nordisk, and we sold it. It had a bad click. We needed a tax loss. Like we had to sell our gains in the gold stocks. How do you offset that? Well, we sold Novo Nordisk, but you know what? It's looking to be a buy. We just have to hold the sale for more than 35 days before we can buy it back. That to me is intriguing. So there's fascinating names, but I think it's where you have to do homework. You just don't buy the healthcare sector. I think you want to concentrate on drugs, appliances, others, and then find the best names in the group. A little more homework's going to be required in this.
Okay. Let's get to another email from Naveen. Can I have your guest views on Rio Tinto? Can I have a target price for 2026? Rio Tinto is in the middle of its own transition, obviously affected by tariffs. What are your thoughts on Rio Tinto?
Rio Tinto, we don't own it. We have a lot of tech in our portfolios, and I'm looking for a home, the next home for tech. The Anglo takeover will take time, but and we like copper, so we're looking for a global metals producer. Now this stock has had a heck of a run, and when you say put a target price on it, it's really hard to do for commodity stocks. You're picking commodity stocks on the basis of number one, do you like the commodity? Are you paying a reasonable valuation level for it? But you don't want to get too low a multiple, because that's never the time to buy it. And a high multiple is actually when you want to buy these because the earnings are bad. So we just have to get a better sense of where the direction of the global industry is going, and then pick our champion. Right now we've been riding tech, and I think those days are more behind us than the combined Anglo tech going forward.
Okay, let's leave it there for now. We're going to come back with new picks from Lyle. Back in just a moment. Join us tomorrow on Market Call. Jason Del Vicario on the show, portfolio manager at Hillside Wealth Management, IA Private Wealth. He'll take your questions on North American and global stocks. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for some new top picks from Lyle, and we're going to start with Agnico Eagle, AEM on the TSX, very well-known brand, of course, and has done pretty well this year. Is it going to do even better next year? Is this where you think there's a lot of growth happening?
It is a growth name. There's no doubt about it. We own it because we like quality. Mm-hmm. We live in an uncertain world. We want to own better quality names than lesser quality names. And Agnico, again, ticks all the boxes. This is a name, as I mentioned, we've owned for a long, long time.
Look at that run up for...
I mean, it's been spectacular. And, the sad thing is, really, for 2025, it has been, as like the last 6 months, an underperformer as the other names, Barrick and Newmont, have caught up. But when you look at Agnico, what are you getting? You're getting safe jurisdictions. So box ticked. You're getting a very low-cost producer. It's all in sales costs are, $1,400 an ounce. Gold today is at $4,400 an ounce. You got a $3,000 an ounce delta. That's all cash to the company. And through the years I've been following this stock, they've got a very good disciplined capital management process, returning the money to shareholders. They said they're going to take down their debt. I think they're debt-free. So they've tick that box. They make smart acquisitions. They buy some juniors to get a footprint. They don't make the big splashy type acquisitions that you might see amongst others. It's just a well-run, well-managed Canadian company that's at the core of our portfolio. The problem is it's gotten to be too big and we have to trim it down because once it gets through 10%, we're saying, we got a little bit more exposure than we might otherwise have.
So you've definitely had to do that this year.
We've had to do it this year. Had to find tax loss candidates, and there weren't a lot of them this year.
Okay, let's move to your second pick, which is Sienna Senior Living, SIA on the TSX, also doing acquisitions, right, across the country. What do you like? Is it a demographic play for you here for Sienna Senior?
Yes, it's demographics, and it fits into that healthcare. Like when we were talking healthcare with the previous caller, healthcare is a growth area because I'm a baby boomer, we're all getting older, and we want to live as long as we possibly can. We like what they're doing in the residence space. When you look at Sienna, it's split between long-term care and a more traditional retirement home. The retirement home business is, I would say, more of a free market than the long-term care. Look at Ontario. Ontario needs 48,000 long-term care beds. The entire Sienna portfolio, which includes primarily Ontario, but BC is number 2 there, 13,000 beds. So they can grow into this. They can make acquisitions, yes, but they can also grow into it. And that's important. The government is creating incentives to grow. So it's kind of like a utility company in many respects. And if you can raise your rates at the level of inflation, you're providing that calamity protection as well as a 4.5% dividend yield. So we get our comfort as well as our calamity protection with Sienna.
As you mentioned, 2 different streams of revenue for the company there. Okay, let's get to your third pick, which is Alphabet, Google, GOOG on the NASDAQ. Of the big tech names, why Google? Why Alphabet?
Okay, so we talked earlier about Amazon and the stability of generating cash flow. When you look at Google today, and it's had a run, but it's hitting on 3 cylinders that I don't think anybody else is. So they've got their TPU chips, the chips that aren't used in compute, but they're used in inference. Increasingly, AI is going to be an inference technology, and their chip is perfectly suited for that. So that's a box tick. Their Gemini 3 is, I think, beating ChatGPT, OpenAI handsomely. That's a go-to. And then, on top of that, you've got their wonderful search business. Now, earlier in the year, concerns that search was going to be destroyed.
Sure.
And look at this, they can use, and they're integrating their Gemini into their search, and so they'll be able to capture much of that market. But the best thing about Google, very simply, is they're generating lots of cash. Any AI-type spending, they can fund internally. That, I think, will leave them as an advantaged player in an uncertain world.
Do you have the same concern others do about the overspend on AI and where the return on revenue is coming?
Yeah, a lot of this gray hair came from the last
This year?
overspend. No. We're going back to 1999, 2000.
Okay.
Yeah, I mean, it's hot, it's exciting. But all of a sudden now, after a year of being hot and exciting, people are starting to find a little cracks in it. Energy being perhaps the biggest crack that is emerging. And so it's going to take longer than I think the market is willing to pay for. I mean, look at back again when I still had dark hair, it was Cisco. Cisco was the great company. It was the star. It was the leader. It had a market cap much bigger than anybody else. The internet did exactly what Cisco predicted it was going to do, but it was the valuations on Cisco in a slowdown that resulted in the 2000 downturn that really whacked the heck out of the stock. And so risk reward, we think there's risk here. So we can get reward if in fact the risk doesn't play out, but we will be reasonably well suited with the cash being generated by Google or, as I mentioned, at Amazon.
Got it. All right, Lyle, thanks for coming in. It's good to see you.
Nice to see you.
Happy holidays.
Thank you so much.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.